So thank you and pleasure having you at Trending Diary. We run a podcast, and it's such an honor to have you on with us today. So you've been writing on the financial markets. I mean, uh, did your name lend itself to your profession?
Chancellor.
Yes.
Um, no. I think when the Financial Times reviewed my book, someone in the commentary section wrote, "People called Chancellor shouldn't write about monetary affairs."
Exactly. So you've written extensively about speculation and speculative bubbles, and as it has formed over the years. You've written extensively about the dot-com bubble, about the housing bubble and the subprime crisis that subsequently engulfed the world. And you also talked about the problems of quantitative easing. So how do you feel about Bernanke getting the Nobel Prize?
Yes, I think it should have been me.
Exactly.
Yeah, I mean, look, I don't belong to the world of the monetary policy makers and monetary economists. They are sort of closed. They're a clique. They don't really listen to people on the outside, and they gave Ben Bernanke, former Fed chairman, was one of the recipients of the Alfred Nobel Memorial Prize in Economics last year, just as the policies that Bernanke had set in place after the global financial crisis, the policies of QE and zero interest rates, were beginning to collapse. So we had, following from that, you had the recurrence of inflation. If you remember, you probably don't remember, back in 2010,
I do.
Bernanke said we could raise interest rates in 10 minutes. And the moment the Federal Reserve started raising interest rates, all hell broke loose, both in the United States, because the US dollar is global reserve currency,
right.
As you know, across the rest of the world, emerging markets were hit, the stock markets around the world were hit, bond markets around the world were hit. So it's quite clear that Bernanke's idea that you could raise interest rates just like that after a period of very low rates in which bubbles have built up, in which a lot of debt had built up, in which a lot of dubious financial practices had been entertained, that was wrong. So I think that the Nobel Prize for Bernanke was mistimed and was really signed by the sort of economics establishment that they neither cared nor observed what was going on in the real world.
Was it irony or was it sarcasm?
Was
it irony or was it sarcasm?
Irony, I'd say.
Irony. So, a lot of the viewers of this, the audience for this podcast are very young people who might not have the vision to understand that cycles keep repeating itself and we keep learning nothing about it. So every era of quantitative easing and low interest rates has seen bubbles grow. And you have spoken at length about crypto, which has been something that has come up and gone down, despite people knowing about altcoins or so-called Dogecoins and etc. having no intrinsic value, still getting traded only for the profit. How do you think humankind in future will be able to control its greed?
No, I don't think there's no.
Gordon Gekko triumphs.
Humans are driven by greed and by fear. In fact, fear is more dominant emotion than greed. In finance, we, as you say, have these cycles. So we have these cycles of booms and busts, of greed and fear. And one of the pleasures of being a financial historian is you see repeated behavior. That there's nothing new under the sun, or as my friend James Grant, the financial historian, says, we keep on stepping on the same rakes, and the rakes keep on hitting us in the face. And so one of the advantages for young people is if they read natural history books, read my books, for instance. They don't have to actually experience the losses themselves. Yeah, so you can actually learn from history.
So sometimes the school of hard knocks is the biggest, educator.
And absolutely, I mean, if you work in investment, you need to lose money in order to gain experience. So
Right.
you can only learn so much from the books, and then you learn from also losing money. So investment, I mean, that sort of makes investment an interesting subject.
Absolutely.
Is you're thinking about stuff, trying to come up, deal with complex problems, and then you make decisions. And then you see whether decisions are right or wrong, and if they're wrong, the best thing to do is to learn from them. Because my old boss, Jeremy Grantham, would say, you have to cry over spilt milk.
That's interesting.
Yeah.
That's interesting. So one thing that I would like to ask you is, over the last several decades, I think from the 70s onwards, capital has been moving away from productive utilization into more financial or speculative assets. So today, if you give a young person, let's say, $1 million, it is unlikely that they will go and set up a productive facility. More likely that they would try to invest it in some financial instrument. How do you think that leverage has affected our understanding of risk?
Yes, well, I think you're right. I think that there are two really parts to an answer to your question. First of all, I would argue that, remember, that the period of very low interest rates, in theory, it should encourage lower the cost of borrowing, encourage people to borrow and establish businesses. In reality, as I say in my book, it actually means that old businesses stay around and never die, and then so you get fewer deaths, business deaths, and when you get fewer business deaths, you get fewer new businesses created. In fact, you get less opportunity for entrepreneurialism. But also, if you get the very low interest rates, you get you bring interest rates down, and central bank prints lots of money. You get these asset price bubbles, and do you want to set up a business that might return 15% a year in 10 years' time, but has 50% chance of failing? Or do you want to just go into a market that is rising 15-20% a year and bet in that market? And this is not just giving money to a young person. This is also true of corporations themselves, which have preferred. I don't think it's a situation here in India, but definitely in the United States, where companies, instead of investing in their ongoing activities, have used their profits, and they borrowed money to buy back their shares.
Exactly.
So
it's happening in India as well.
It is, yeah.
So the cash reserves are getting, put into buying back the shares, and thereby buying the prices of the shares further.
And my argument is that ultra low interest rates, or too low interest rates, encourages financial engineering, or as a London economist called Jan Toporowski says, in an age of finance mostly finances finance.
Finance. That's so correct.
Yeah.
So one thing that I have noticed is that in case of bubbles or such market collapses, what happens is that the people who perpetrated it, the people who fell towards irrational exuberance, as the famous term goes, they get away with it. The bankers kept getting their bonuses and kept getting bailed out as too big to fail. But it's the person at the bottom of the pyramid who gets hit the hardest. So if you look at the cost of living crisis that is hitting the UK at the moment.
I agree with you.
So how does one work around that structurally?
I have a chapter in my book on how the very low interest rates of recent years has actually contributed to wealth and income inequality. And the way you understand that is people, older people who own houses and shares.
I was going to come to that.
When the interest rates go down, they become richer. Whereas if you don't own any assets and you're young, then the house price goes up, can't afford to buy a house, and if the interest rate's low, you put your money in the bank and you get no return on your money, and then what you do with your money, you put it in cryptocurrency and you lose it all in a cryptocurrency. And then if you think about income, in people who own companies, senior executives who are paid with stock options and whose payments related to the share price, their income rises with the stock market, and therefore they become richer when low interest rates inflate high asset prices. And then you have the bankers, and the bankers, when rates are low, it's much easier to do deals, and the bankers get paid fees for the deals. And then, if you work in the investment business, your income is just a derivative of the level of the market. Right. So you see, put all that together, and then you can, and this is my argument, is that the low rates actually benefit the rich and the bankers and the financiers, and they hurt those who are not, and in particular they hurt they hurt younger people. And another thing that is constantly overlooked is that poorer people have more of their financial assets in cash.
In cash, absolutely.
Whereas richer people,
as opposed to instruments.
Yeah, and whereas richer you are, the more likely you are to engage in some form of financial engineering. You invest in private equity companies and such, which use debt to enhance value. So, in fact, the irony of the modern world is that the richer are taking the money when interest rates are low from the poor.
Correct. And
using that money to enhance their
own wealth.
So I think it creates inequality. And actually, my book, I say, remember the Thomas Piketty, the French economist?
Of course.
And he says that when
his tone is quite.
He says inequality that increases when the rate of return is higher than the rate of GDP growth.
Right.
And I argue that actually when the rate of interest also is lower than growth, that actually
inequality
increases. So
the Gini index keeps going up.
I say that Piketty's formula is correct. It's just the sign has to be turned round. It's exactly wrong.
That makes sense. My last question to you would be about about what is happening. So you see, India is a demographic. It's a Christmas tree at the moment,
which is good.
Yes, so we have
India has the best demographics in the world
with us. But if we look at societies that are getting older, India, I mean, China has recently reported their population to have gone down by 800,000, almost 1 million people, and their average age has gone up to 35. If you look at US or Europe or the UK,
US I think is okay.
So US, the baby boomers have now their labor forces through immigration mainly, and their birth rate has also been comparatively higher than the others. But the
I
older
think Europe
generation
has the worst demographics.
Europe probably has.
China,
Japan. South Korea coming ahead. South Korea coming ahead. So one of the inequalities, I mean, it is also an intergenerational inequality of opportunities. So the older generation, as you just said now, have acquired all the houses and the assets, and they're sitting on them. And no offense intended, the lifespan is getting longer.
Up until COVID.
So how do you think this will play out, and how long do you see a revolution coming?
A revolution's a strong word.
Intended.
I mean, my argument in the book was that the low rate era has built up inequality, and it has slowed economic growth, and it's created a perception of unfairness. And if you put all that together, people's confidence in capitalism declines, and even their confidence in democracy
Correct.
clients.
Absolutely.
And so you then get a position where there's potential for pushback. Now you say,
Pushback, yes.
Yeah, and so I think that
Revolution
pushback,
is a stronger word, but yes.
pushback I think comes in possibly in the form of a shift to higher taxes, wealth taxes, higher taxes on corporations, restrictions on international capital.
I mean, as we've seen in Davos, the ultra rich are now saying, hey, please tax us, hey, please tax us, after having gone to the Cayman Islands in Ireland to evade their taxes. Wonderful. Thank you so much. It's been a pleasure speaking with you.
Thank you.